We all look towards Greece and equities as being the real investment danger. However, the danger might not come from that part of the world. We need to look closer at the US. If we look at the US, we clearly see that through the quantitative easing program, which the US has executed over the last 6 years, that a bubble in fixed income was created. And this bubble could definitely have an impact of historic proportions. The Fed has been buying securities for over 4,000 billion, and the impact was that the prices were pushed up, yields were being pushed down. Indeed, we have yields of 1.6%. The last time we have had yields on 10-year treasuries of close to 2% was a long time ago. It was actually 1945. To fully appreciate this, it's probably also worthwhile knowing that the 50-year average on 10-year US Treasury yields is more like 6.5%. We believe, however, that the quantitative easing was the right thing to do in the United States. It helped to jumpstart the economy, and we can clearly see that the economy today is very strong. Growth has come back. The US 6 years ago was like a patient which was on life support. And through the quantitative easing, this patient started to walk again. But let's not fool ourselves. This patient is still on steroids. Steroids meaning low cost of capital. We believe that this bubble will burst at some point in the foreseeable future. Today, we have yields on the 10 years of roughly 2%. We expect in the foreseeable future to see yields between 3 and 4%. Now, it's probably worthwhile highlighting that a move of 100 basis points will result in a mark-to-market loss for investors of nearly 9%. The last time we had actually double-digit losses on a safe asset like US Treasuries was in the 70s. If we see a disorderly rate increase, there will clearly be a disorderly sell-off of US Treasuries. It's like an elastic band which has been stretched very far, and sooner or later it will snap back. Wealth destruction will be terrible here because both private investors and financial institutions such as banks and insurances will suffer. What clearly has changed is that today the US Treasury market takes its lead from European investors. European investors, as they are exposed to very low yields or in their hunt for yields, looking much more carefully to the US. And if they see that the spread between European securities and US securities gets very large, clearly they will come and they will buy this. So to a certain degree, you could say actually that European investors might act as a stabilizer, and the market probably will give enough time to the US market to get back to normality again. There's some real potential that US Treasuries might sell off, and this would be very wealth destructive. So our advice to our client is, if you don't like to take any chances on this, please stay away.